Hi everyone, today we're covering the largest and most liquid financial market in the entire world, the foreign exchange market, also known as Forex. We'll walk through its background, how it's actually works, how traders and investors earn from it, its advantages and disadvantages, some of the top currencies and platforms involved, and finally our conclusion on where Forex fits compared to other options in our project. The foreign exchange market is the global marketplace where currencies are bought, sold, and exchanged for one another. Every time a business imports goods, a tourist exchanges money for a trip, or an investor moves funds across countries, a currency exchange happens somewhere in this market. To put its scale into perspective, Forex is by far largest financial market on earth, with trillions of dollars worth of currency traded every single day, far surpassing the combined daily volume of every stock exchange in the world. Unlike the stock market, which operates from a centralized exchange with fixed hours, Forex is decentralized, over-the-counter market that operates 24 hours a day, 5 days a week. A trading moves seamlessly between major financial centers in Tokyo, London, and New York as the sun moves around the globe. The modern Forex market as we know it really took shape after 1971, when the Bretton Woods system, under which currencies were pegged to a fixed value of gold, collapsed, and major currencies shift to a floating exchange rate system, where their value is determined by supply and demand rather than a fixed peg. This single shift is what created the dynamic, constantly fluctuating currency market that exists today. In the Philippines, the Forex market matters enormously in everyday economic life. It directly affects the cost of imported goods, the value of overseas Filipino worker remittances sent home in a foreign currency, and the profitability of Philippine export businesses. The Bangko Sentral ng Pilipinas monitors and occasionally intervenes in the Forex market to help manage the peso stability against major currencies like the US dollar. So how does the Forex market actually function? First, currency pairs. Unlike stocks, which are bought individually, currencies are always traded in pairs because you're simultaneously buying one currency while selling another. For example, the pair US dollar and the Philippine peso shows how many Philippine peso are needed to buy $1. If the US dollar or Philippine peso is at 58.50, that means 58.50 pesos buy $1. Second, market participants. The Forex market involves several types of players. Central banks, managing monetary policy and currency stability. Then, commercial banks facilitate larger scale currency transaction. Corporation exchange currency for international trade, institutional investor like hedge funds, and individual retail traders who trade through online platforms. The third is exchange rate determination. Currency values fluctuate constantly based on supply and demand, which is driven by factors like a country's interest rate, inflation, political stability, trade balances, and overall economic performance. For example, if the Bangko Sentral ng Pilipinas raises interest rates, the peso often became more attractive to foreign investors seeking higher returns, which can strengthen its value against other currencies. The fourth one is trading mechanism. Retail traders typically access the Forex market through an online broker platform, depositing funds and then buying or selling currency pairs based on their expectation of how exchange rate will move. Trades can be entered and executed within seconds, making Forex one of the most immediately liquid market available. Then the fifth and last is the leverage. A distinctive feature of Forex trading in the widespread use of leverage brokers allow traders to control a much larger position than their actual deposited capital, sometimes 50, 100, or even 500 times their investment. This means small currency movements can create outsized gain or losses relative to the trader's actual capital. Forex returns come primarily from correctly predicting currency movement. Buying low, selling high. If you believe a currency will strengthen, you buy it now and sell it later at a higher exchange rate, profiting from the difference. For example, buying US dollar or Philippine peso at 58 and selling it at 58.80 earns a profit on the difference multiplied by the size of your position. And then, interest rate differentials or carry trade. Some traders use a strategy called the carry trade, borrowing in a currency with a low interest rate and investing in currency with a higher interest rate, profiting from the interest rate gap in addition to any favorable exchange movement. And then, the leverage amplification. Because of leverage, even small percentage movement in a currency pair can translate into significant percentage gain related to the trader's actual invested capital. Though, importantly, this cuts both ways and can just as easily apply losses. And then, short-term trading participants trade very short-term, sometimes holding positions for mere minutes or hours based on news and technical price patterns, while others hold longer-term positions based on broader economic trends, such as anticipating a country's currency strengthening over several months due to improving economic fundamentals. Forex trading is essentially a zero-sum, highly speculative activity in the short term. One trader's gain is generally another's loss. Return depend heavily on scales, timing, information, and risk management, rather than the steady, contractual nature of something like a bond. Here's why the Forex market attracts so many participants. First, extremely high liquidity. With trillions traded daily, Forex position can almost always be entered and exited instantly without the price slippage risk that smaller or less trader market might face. Second, 24/5 market access. Since trading shifts between global financial centers, the Forex market is open nearly around the clock during the business week, offering flexibility that stock market with their fixed daily hours don't provide. And then, low entry barriers. Many Forex brokers allow trading with relative small starting capital, making it more accessible than some other investment options that require significant upfront funds. And then, profit potential in both directions. Traders can profit whether a currency is rising or falling, since Forex allow both buying and short selling with equal ease, unlike some other markets where profiting from a decline is more complicated. However, Forex carries some of the highest risk among common investment options. First is the extreme volatility. Currency values can swing sharply due to unexpected economic news, political events, or central bank's decision, making Forex one of the more unpredictable markets to navigate. And then, leverage risk. While leverage can amplify gains, it equally amplifies losses. It's entirely possible to lose significantly more than your original deposit if a trade moves against you without proper risk control in place. And then, high skill and knowledge requirement. Successfully trading Forex requires understanding macroeconomic, technical analysis, and risk management. It is not a passive sit-in and forget-it type of an investment. And then the emotional and psychological pressure. Because trade can move quickly and losses can escalate fast, Forex trading is often mentally demanding and impulsive decision-making driven by fear or greed in a common pitfall for beginners. And then the last is the scam and unregulated broke risk. Because Forex trading has grown popular, it has also attracted unregulated or fraudulent brokers promising unrealistic returns. Investors need to verify that any broker they use is properly licensed and regulated. Some of the most actively traded currencies and access points include major currency pairs. The US dollar and Philippine peso, the euro and US dollar, and other are among the most heavily traded pairs globally, offering high liquidity and tighter trading costs. And then the US dollar. Considering the world primarily reserve currency involved in the majority of all Forex transactions worldwide. And then, regulated retail brokers. Platforms regulated by recognized authorities, such as the Bangko Sentral ng Pilipinas for Philippine-based Forex activities or major international regulators for global brokers, provide safer and more transparent access to Forex trading for retail participants. In conclusion, Forex is best suited for experienced, risk-tolerant investors who have taken the time to study macroeconomics and market analysis. It is more recommended for beginners looking for stability, predicting growth, given its high volatility and the amplified risk that comes with leverage, compared to safer, more contractual options like bond or digital banks. Forex offers the potential for significant short-term gains, but at meaningfully a higher risk of significant topic to study. That wraps up our discussion on the Forex exchange market. Thank you for watching.